Competent parties in insurance contracts. When entering into an insurance contract, it's important to understand who qualifies as a competent party. In most cases, individuals are presumed to be legally competent unless proven otherwise. However, there are exceptions. Minors, individuals who are mentally incapacitated, and those under the influence of alcohol or drugs are generally not considered competent to enter into a legally binding insurance contract. The reason for this is that state laws typically hold that minors below a certain age cannot fully comprehend the implications of a contract. However, business entities, trusts, and estates are all considered competent parties. So if you ever see a question asking which of these is not considered competent, the correct answer would be minors. Types of authority in insurance. Authority in insurance is a big deal, especially when it comes to what an agent can and cannot do. There are three main types of authority you should be familiar with. Express authority is the authority that is explicitly granted to an agent in their contract with the insurer. Implied authority, on the other hand, is not written out but is assumed as necessary to carry out express authority. Then we have apparent authority, which is what a third party, like a customer, believes the agent has based on how the insurer presents them. For example, if an agent is given business cards, sample policies, and rate books from Zephyr Insurance Company and then tells a client they have unlimited binding authority, the client is likely to assume that this is true. Even if it isn't, the company may still be held responsible because the client's assumption is based on the company's actions. Characteristics of an insurance contract. Insurance contracts have certain characteristics that make them unique. Some of the most important include utmost good faith, adhesion, and indemnity. Utmost good faith means that both the insurer and the insured are expected to be completely honest with each other. No hidden details or misleading information. Adhesion means that the insurance company drafts the contract, and the insured must accept it as written. If there's any ambiguity, courts usually rule in favor of the policyholder because they didn't have a say in writing the contract. Indemnity is the principle that insurance is meant to restore a policyholder to their financial position before a loss, not provide them with a financial gain. If a question asks which of the following is not a characteristic of an insurance contract, and one of the choices is legal purpose, remember that while legal purpose is an essential element of any valid contract, it is not a defining characteristic of an insurance contract. The agent's primary duty in transactions. One of the biggest responsibilities of an insurance agent is to serve the insurer. A licensed insurance agent legally represents the insurance company in all transactions. That means their primary duty is to the company, even though they work directly with clients. In disputes between the insured, or a beneficiary, and the insurer, the agent's role is to uphold the policies and procedures of the insurer. Utmost good faith in insurance contracts. The concept of utmost good faith is fundamental in insurance. This principle requires that both the policyholder and the insurance company be completely transparent. Neither party should try to deceive or conceal important details. If a policy is purchased based on what the insurer and the agent claim about its benefits and features, then the insurer, in turn, is issuing the policy based on the information the applicant provides. If either side fails to disclose important details, the entire contract can be challenged. Parties in a life insurance contract. A life insurance contract is an agreement between two main parties: the applicant, who is typically the policy owner, and the insurance company. The agent, while an important figure in the process, is not a party to the contract. Similarly, the beneficiary, the person who will receive the death benefit, is also not a contracting party. If a question asks who the parties to a life insurance contract are, the correct answer is always the applicant and the insurance company. Characteristics of an insurable risk. For a risk to be insurable, it must meet several criteria. The risk must be affordable, meaning that the cost of insurance premiums must be reasonable relative to the potential loss. It must also be measurable, which means that the insurer must be able to determine the likelihood and potential cost of a loss. Additionally, the risk must be calculable. Insurers need to be able to estimate potential claims using actuarial data. But perhaps most importantly, the risk must be accidental. If a loss is intentional, then it isn't really a risk at all. It's a certainty. Insurance is designed to cover unexpected events, not deliberate actions. That's why an intentional loss is not considered an insurable risk. Fiduciary duty of insurance producers. An insurance producer has a fiduciary duty to handle client funds responsibly. This means that any premiums received must be held in trust and cannot be used for personal expenses. These funds belong to the insurer until the policy is issued, and they must be managed carefully. A producer who misuses premium funds is violating their legal obligations and could face severe penalties. Fraternal benefit societies. Fraternal benefit societies are unique organizations that exist for the benefit of their members. Unlike commercial insurers, they operate under a lodge system and often provide life insurance as a membership benefit. However, one thing to remember is that their policies are called certificates, and the policy holders are known as certificate holders, not policy owners. This is a commonly tested fact, so make sure you remember that distinction. Forms of commercial insurers. A commercial insurer is categorized based on its form of ownership. The most common types are stock insurance companies, mutual insurance companies, and fraternal benefit societies. However, individual benefit societies are not considered a form of commercial insurance. If you see a question asking which of the following is not a commercial insurer, and one of the choices is an individual benefit society, that's the answer you should go with. Legal protection in insurance contracts. One of the ways insurance contracts protect policyholders is through the principle of adhesion. Because the insurer is the one who drafts the contract, the insured is given little to no opportunity to negotiate the terms. As a result, if any part of the contract is ambiguous or unclear, courts will typically rule in favor of the insured. This ensures that insurance companies cannot take advantage of policyholders by creating overly complicated or misleading language in their policies. Lloyd's of London and its role in insurance. Lloyd's of London is often misunderstood as an insurance carrier, but in reality, it is not an insurer at all. Instead, it is an association of individuals and companies that individually underwrite insurance. Think of it as a marketplace where various members, called syndicates, come together to offer coverage, often for unique or high-risk situations that traditional insurers might avoid. Lloyd's plays an important role in the industry by gathering and sharing underwriting information and helping its members settle claims and disputes. So, if you come across a question asking which statement about Lloyd's of London is not correct, remember that Lloyd's does not function as a single insurance carrier. Conditional nature of insurance contracts. Insurance contracts are classified as conditional contracts because the insurer's obligations depend on specific actions taken by the policy owner or the beneficiary. For example, the insurer agrees to pay benefits only if the policy owner has met conditions such as paying premiums on time or submitting proof of loss in the event of a claim. This is different from a bilateral contract, where both parties are equally obligated, or a unilateral contract, where only one party, the insurer, makes an enforceable promise. In the exam, if you see a question about why insurance contracts are conditional, it's because the insurer's responsibilities only activate once the insured fulfills certain conditions. Reciprocal exchanges in insurance. A reciprocal exchange is a unique type of insurance arrangement in which policyholders essentially insure each other. This is different from a traditional insurance company, where a single entity assumes all the risk. In a reciprocal exchange, each member, referred to as a subscriber, agrees to share the risks of other members. These exchanges are managed by an attorney-in-fact, who handles administrative duties on behalf of the group. It's a cooperative form of insurance that operates based on mutual agreement among its members. Facultative versus treaty reinsurance. Reinsurance is a critical part of the insurance industry because it allows insurers to transfer risk to another company, reducing their exposure to large losses. There are two primary types of reinsurance: facultative and treaty reinsurance. Facultative reinsurance is when the reinsurer evaluates each risk individually before agreeing to cover it. This means they consider risks on a case-by-case basis. Treaty reinsurance, on the other hand, involves a standing agreement where the reinsurer automatically accepts certain types of risks from the ceding company without reviewing them individually. If you see a question about facultative reinsurance, remember that it involves individual risk evaluation before acceptance. Characteristics of an insurable risk. For something to be considered insurable, it must meet 6 key criteria. It must be calculable, affordable, non-catastrophic, homogeneous, accidental, and measurable. A risk must be non-catastrophic because insurance is designed to cover predictable losses affecting only a limited number of policyholders at a time. Insurers generally will not cover catastrophic events like war, large-scale natural disasters, or risks that could wipe out an entire insurance pool. Additionally, insurable risks must be accidental. If a loss is intentional or premeditated, it is not considered insurable. When answering questions about insurable risks, remember that insurers avoid catastrophic and intentional losses. Types of agent authority. In insurance, express authority is the authority explicitly granted to an agent through their contract with the insurer. This is different from implied authority, which consists of actions the agent is reasonably expected to perform even if they aren't specifically stated in the contract. Then there's apparent authority, which is what a third party, like a customer, assumes the agent has based on the insurer's actions. The correct answer to any exam question asking about authority given by contract is express authority. Insurer's responsibility for an agent's actions. If an agent fails to perform an act required by a policy, the insurer is still responsible for fulfilling its obligations to the policyholder. This is because the insurer is legally bound by the actions of its licensed agents, as long as those agents are acting within their scope of authority. Even if an agent makes a mistake, the insurer is still liable for meeting its contractual duties. The key takeaway here is that an insurer is accountable for its agents' actions when those agents have an active contract with the company. Contract terminology in insurance. Understanding insurance contract terminology is crucial for the exam. The term adhesion refers to the fact that the insurance company drafts the contract, and the insured has no room to negotiate its terms. A unilateral contract means that only one party, the insurer, is legally obligated to fulfill the agreement. Conditional contracts, as mentioned earlier, depend on the policyholder fulfilling specific requirements for the insurer's promise to be carried out. Finally, an aleatory contract means that the values exchanged by both parties may not be equal. An insured could pay premiums for years and never file a claim, or they could pay just a few premiums and receive a large payout. If you see a question about which term refers to unequal value between parties, the answer is aleatory. Control over insurable risks. A fundamental rule of insurance is that the risk being insured must be outside the control of the insured. This is why only pure risks, Risks that involve the chance of loss but no opportunity for financial gain are insurable. If a question asks whether an insurable risk must involve loss within the insured's control, the answer is no. Insurance covers unexpected and uncontrollable risks, not deliberate or manageable losses. Independent rating agencies and insurer evaluation. Independent rating agencies assess the financial strength of insurance companies by looking at key factors such as loss experience, reserves, investment performance, management, and operating expenses. However, one thing they do not consider when evaluating financial strength is the number of agents an insurer has. If a question asks what independent rating agencies don't take into account, that's your answer. Elements of an insurable risk. For a risk to be insurable, it must meet several conditions. The loss must have a determinable value, meaning insurers must be able to estimate the cost of the claim. The loss must be predictable, allowing insurers to anticipate future claims based on past data. It must also be the result of chance, meaning it cannot be intentional. However, an insurable loss must not be catastrophic. If an event has the potential to affect a vast number of people or cause a financial disaster for the insurer, it is not insurable. This is why war and major natural disasters are often excluded from standard insurance policies. If you see a question asking which of the following is not an element of an insurable risk, and catastrophic is an option, that's the correct answer. Fiduciary responsibility of a producer. A producer is in a fiduciary position, meaning they hold a financial responsibility to both the insurance buyer and the insurer. This means that when a producer collects premiums or refunds payments for canceled policies, those funds must be handled appropriately and promptly returned to the correct party. However, this fiduciary duty does not extend to the commissioner or director of insurance, as no financial trust exists between them and the producer. So if you're asked who a producer does not owe fiduciary responsibility to, the correct answer is the commissioner. Unilateral nature of life insurance contracts. A life insurance contract is unilateral, which means that only one party, the insurer, makes an enforceable promise. The insurer commits to paying the policy's benefit if specific conditions are met, such as the death of the insured or a disability event. The policy owner, however, is not legally required to continue paying premiums and can let the policy lapse at any time. This is a crucial distinction because it shows that the insured has flexibility, while the insurer has an obligation to uphold the contract. Types of insurance companies. Insurance companies can be structured as either stock or mutual insurers. A stock insurance company is owned by stockholders, and its primary goal is to earn a profit. Any dividends paid by a stock company go to the stockholders, not the policyholders. In contrast, a mutual insurance company is owned by its policyholders, and any dividends are typically returned to them. If you ever see a question asking whether a stock company is owned by policyholders, that statement would be incorrect. Policyholder ownership applies to mutual insurers. Defining a peril is simply the cause of loss. For example, in health and life insurance, perils include illness, injury, and premature death. In property insurance, perils might include fire, theft, or natural disasters. Insurance is designed to protect against financial loss from covered perils by transferring the risk from an individual or business to an insurance company. If a question asks what a peril is, the answer is always that it is a cause of loss. Representations in insurance applications. When an applicant fills out an insurance application, they make statements about their health, lifestyle, and medical history. These statements are called representations. They are believed to be true to the best of the applicant's knowledge, but they are not guaranteed to be true. This is different from a warranty, which is an absolute guarantee of truth. So, if an applicant provides information that later turns out to be incorrect, it is not automatically considered fraud, as long as they did not intentionally misrepresent the facts. Risk retention groups. A risk retention group is a special type of mutual insurance company that serves people in the same profession or industry. These groups are often formed to help businesses or professionals, such as lawyers, doctors, and engineers, manage commercial liability risks. Unlike fraternal benefit societies, which are based on social or religious affiliations, risk retention groups focus on occupational risk. If you see a question about a mutual insurer designed specifically for professionals, the correct answer is risk retention group. Waivers and Estoppel. In legal terms, a waiver is the voluntary relinquishment of a known right. If an insurer waives a policy condition, it means they have given up the right to enforce that condition later. However, once a waiver has been granted, the legal principle of estoppel prevents the insurer from denying a claim based on the waived condition. For example, if an insurer repeatedly accepts late premium payments without canceling the policy, they may be estopped from later enforcing a strict payment deadline. Surplus lines insurers. Some insurance risks are too large or too specialized for traditional admitted insurers to cover. When this happens, coverage may be obtained through a surplus lines insurer. These insurers operate outside of the state's standard regulations and do not have a certificate of authority from the state, but they provide coverage for unique or high-risk situations that standard insurers avoid. If you come across a question about which insurer handles specialized risks that admitted insurers won't cover, the correct answer is surplus lines insurer. Who do independent insurance agents represent? Unlike captive agents who work for one company, independent insurance agents represent multiple insurers. Their job is to help clients compare coverage and find the best policy for their needs. However, it's important to remember that even though they work with multiple insurers, they are still representatives of the insurance companies, not the insured. If you see a question about whom an independent agent represents, the correct answer is the insurer. Consideration in insurance contracts. In contract law, consideration refers to something of value that each party gives in exchange for something else. In insurance, the insured's consideration is the premium they pay, while the insurer's consideration is the promise to pay valid claims. Without consideration from both sides, a contract is not legally enforceable. If you see a question asking what consideration means in an insurance contract, the correct answer is the exchange of value between the insured and the insurer. Competency in contract law. For a contract to be valid, all parties must be legally competent when they enter into the agreement. In most cases, applicants are presumed to be competent unless proven otherwise. However, if someone signs an insurance contract while intoxicated, they may not be presumed competent at the time of signing. In this case, the contract would be voidable at the insurer's option, meaning the insurer can choose whether to enforce or cancel the contract. Illegal acts, commingling, and theft. Insurance producers are responsible for handling premium payments on behalf of insurers. These funds must be kept separate from personal funds and handled as trust money. If a producer mixes personal and client funds, it is called commingling, which is an unethical practice. If the producer actually uses the funds for personal gain, it is considered theft, which is illegal and punishable by law. Unilateral nature of insurance contracts. Insurance contracts are unilateral, meaning that only one party, the insurer, makes a legally binding promise. The insurer is obligated to pay claims if the insured meets the policy conditions, but the insured is not required to continue paying premiums. If the insured stops making payments, the policy simply lapses. If a test question asks, "What type of contract is a promise in exchange for an action?" the correct answer is a unilateral contract. Definition of an insurance agent. An insurance agent is someone who solicits, negotiates, procures, or effects insurance or annuity contracts on behalf of an insurer. This means that agents do not just sell insurance, they also play a key role in processing applications and ensuring clients get the right coverage. If a question asks which of the following defines an insurance agent, the answer should include soliciting, negotiating, and procuring insurance on behalf of an insurer. Dividends in stock versus mutual companies. When it comes to dividends, there's a major difference between stock and mutual insurance companies. Stock companies are owned by investors, stockholders, and if dividends are declared, they go to those stockholders. Mutual companies, on the other hand, are owned by their policyholders, so any dividends go to them instead. If a test question asks whether stock companies pay dividends to policyholders, that statement would be incorrect. Stock company dividends are for stockholders, not policyholders. Risk retention groups, RRGs, and their purpose. A risk retention group, RRG, is a special type of insurance provider that exists solely to provide liability insurance to its policyholders. Unlike traditional insurers, RRGs are limited to policyholders who are in the same industry or profession. This allows professionals, such as doctors, lawyers, or contractors, to insure themselves collectively against liability risks. Although RRGs may operate in multiple states, they are regulated by the state in which they are headquartered, not by federal authorities. If a test question asks whether RRGs provide all types of insurance, remember that they only offer liability insurance. Elements of a legal contract. For any contract, including an insurance policy, to be legally enforceable, it must contain 4 essential elements. Competent parties. Both parties entering the contract must be legally capable of doing so, not minors, mentally incapacitated, or intoxicated. Legal purpose. The contract must be for a lawful purpose. For example, you cannot take out an insurance policy on an event designed to commit fraud. Agreement. This includes an offer, the application for insurance, and acceptance when the insurer issues the policy. Consideration. Each party must exchange something of value. The insured provides premium payments, and the insurer provides a promise to pay claims. One element that is not required for a valid contract is representations. Representations are simply statements made by the applicant during the application process, and they are not an essential element of contract formation. Fraternal benefit societies. A fraternal benefit society is a nonprofit organization that provides insurance benefits to its members. These societies operate on a lodge system, meaning they have a structured membership and governance process. They do not issue capital stock and must have a representative form of government. One key thing to remember is that if a fraternal society offers insurance benefits, it must still be licensed and must file annual financial statements with regulators. If a question asks whether these societies are exempt from licensing requirements, that statement is incorrect. Representations in insurance applications. A representation is a statement that an applicant believes to be true to the best of their knowledge. However, representations are not guaranteed to be true. If a representation is later found to be false but not material, it will not void the insurance contract. However, if the false representation is material, meaning it would have impacted the insurer's decision to issue the policy, the insurer may have grounds to void the contract. Types of authority. Apparent authority. Authority in insurance is classified into express, implied, and apparent authority. Apparent authority is what a reasonable person would assume based on the agent's actions and company branding. For example, if an agent displays the insurance company's logo on their apparel, vehicle, or office materials, a client might assume the agent has full authority to act on behalf of the company. This is apparent authority. It is not explicitly granted, but is inferred based on how the agent presents themselves. The role of a general agent. A general agent is responsible for recruiting, hiring, training, and supervising insurance agents within a certain geographical area. General agents do not sell policies directly to consumers. Instead, they manage other agents who sell policies. This role is different from a special agent who typically has a limited, specific assignment. Moral hazards in underwriting. A moral hazard refers to an applicant's lifestyle or personal habits that may increase the likelihood of filing a claim. Unlike a physical hazard, such as a dangerous job, or a peril, such as illness or injury, moral hazards relate to behavior. Examples include excessive drinking, drug use, or reckless dieting. Insurers carefully evaluate moral hazards during underwriting to assess potential risks. Key elements of a contract. Contracts in insurance must include agreement, consideration, competent parties, and legal purpose. However, acknowledgement is not an essential element. If a question asks which of the following is not a required contract element, acknowledgement would be the correct answer. Treaty reinsurance and risk sharing. Reinsurance is the process of an insurance company transferring some of its risk to another insurer. There are two main types of reinsurance. Facultative reinsurance. The reinsurer evaluates each individual risk before accepting it. Treaty reinsurance. The reinsurer agrees in advance to accept a certain class of risks without evaluating them individually. If you see a question asking about a reinsurance agreement where the reinsurer automatically covers a specific category of risks, the answer is treaty reinsurance. Affordability of insurance premiums. When transferring risk through an insurance policy, the premium must be affordable for the average customer. If premiums are too high, consumers won't purchase coverage, and the risk pool will shrink. The ideal premium structure is affordable, yet sufficient to cover claims and company expenses. Implied authority in insurance transactions. Implied authority refers to actions an agent can reasonably take, even if they are not explicitly stated in their contract. For example, if an agent is authorized to sell policies, it is implied that they can also collect premiums and obtain client signatures. Unlike express authority, which is explicitly granted in writing, implied authority is assumed based on the agent's responsibilities. Characteristics of fraternal benefit societies. A fraternal benefit society is a non-profit, member-based organization that provides insurance benefits. It must have a representative form of government and operate on a lodge system. However, it is not a profit-making organization with capital stock. If you see a question asking which of the following is not a characteristic of fraternal societies, the correct answer is profit-making organization with capital stock. Mutual insurers and participating policies. A mutual insurer is owned by its policyholders, and it issues participating par policies. If the company earns a profit, it may return non-taxable dividends to its policyholders. This is different from a stock insurer, which is owned by shareholders and distributes profits to them instead of to policyholders. If a test question asks whether mutual insurers issue participating policies, the correct answer is yes. Direct writing companies and business ownership. A direct writing insurance company sells policies through salaried employees rather than independent agents. The key distinction here is who owns the book of business. In direct writing companies, the insurer owns all policies sold. The producer, agent, does not own the book of business. If a question asks whether producers in a direct writing company own their business, the answer is no. Only the insurer owns the business.